Hello and welcome to this video about the key takeaways from The Intelligent Investor by Benjamin Graham. This book is widely considered one of the most influential and important books on value investing, and has been a cornerstone for many successful investors. In this video, we will cover the key takeaways from each chapter of the book, providing you with insights that will help you become a more intelligent and informed investor. Chapter 1. Investment versus Speculation. The first chapter of the book distinguishes between investing and speculation. Graham argues that investing focuses on intrinsic value and long-term profitability, while speculation focuses on market trends and short-term profits. According to Graham, investors should focus on investing rather than speculation, as it provides more reliable returns over the long term. The chapter emphasizes the importance of analyzing a company's fundamentals, such as its earnings, dividends, and assets, to determine its intrinsic value. Graham suggests that investors should only purchase stocks when they are trading at a discount to their intrinsic value, providing a margin of safety against market fluctuations. Chapter 2. The Investor and Inflation. In Chapter 2, Graham discusses how inflation affects investments and why investors should consider it in their decisions. He highlights the importance of protecting investments from inflation, which erodes their purchasing power over time. Graham advises investors to seek out investments that provide a hedge against inflation, such as stocks or real estate. He suggests that investors should look for stocks of companies that have the ability to increase their prices to keep pace with inflation, such as those in the energy, utilities, or healthcare sectors. Graham also highlights the importance of diversification in protecting against inflation risk. Chapter 3. A Century of Stock Market History. Chapter 3 provides a historical overview of the stock market, showing how trends and cycles emerge over time. Graham highlights the importance of understanding the cyclical nature of the market and how it can impact investments. He also emphasizes the importance of a long-term perspective when investing, as the market tends to recover over time. The chapter suggests that investors should not try to time the market, but rather focus on investing in quality companies with strong fundamentals. Graham advises investors to avoid market fads and to remain disciplined in their investment approach. Chapter 4. General Portfolio Policy. The Defensive Investor. Chapter 4 introduces the defensive investor and how they should construct their portfolio. This type of investor emphasizes safety and income through diversification, and should focus on preserving capital. Graham advises defensive investors to invest in bonds or other fixed income securities, as they provide a reliable source of income. The chapter suggests that investors should aim for a balanced portfolio of stocks and bonds, with a focus on quality and diversification. Graham advises defensive investors to avoid high-risk investments and to remain patient in their investment approach. Chapter 5. The Defensive Investor and Common Stocks. In Chapter 5, Graham explains how common stocks can play a role in a defensive investor's portfolio. He advises defensive investors to evaluate stocks based on value, quality, and diversification potential, rather than market trends. Graham also highlights the importance of a margin of safety, which protects investors from the downside risk of a stock. The chapter emphasizes the importance of diversification and patience in investing. Graham suggests that defensive investors should consider mutual funds or index funds as a way to diversify their portfolio with minimal risk. Chapter 6. Portfolio Policy for the Enterprising Investor. Negative Approach. Chapter 6 discusses portfolio management for enterprising investors, who are willing to take more risks in their investments. It emphasizes the importance of research and analysis in selecting stocks, and advises investors to avoid stocks with poor fundamentals. Graham also advises investors to diversify their portfolio, even if they are taking on more risk. The chapter suggests that enterprising investors should consider stocks that are undervalued, and which have the potential for growth. It also emphasizes the importance of a margin of safety, which can protect investors from the downside risk of a stock. Graham advises enterprising investors to avoid speculation and to remain disciplined in their investment approach. Chapter 7. Portfolio Policy for the Enterprising Investor. The Positive Side. Chapter 7 continues the discussion of portfolio management for enterprising investors. It suggests that enterprising investors should focus on identifying stocks that are undervalued, have a strong balance sheet, and which have the potential for growth. Graham advises investors to analyze a company's financial statements, such as its income statement and balance sheet, to determine its intrinsic value. The chapter highlights the importance of diversification, as well as the need for patience and discipline in investing. Graham advises enterprising investors to avoid market fads and to focus on companies with a history of solid earnings and dividends. Chapter 8. The Investor and Market Fluctuations. Chapter 8 discusses the impact of market fluctuations on investments, and provides guidance on how to respond to market changes. Graham advises investors to avoid emotional reactions to market fluctuations, and to remain disciplined in their investment approach. He suggests that investors should take advantage of market downturns by purchasing quality stocks at discounted prices. The chapter emphasizes the importance of a long-term perspective in investing, and advises investors to focus on quality and diversification. Graham also warns investors against speculation and the dangers of trying to time the market. Chapter 9. Investment versus speculation. Results to be expected by the intelligent investor. Chapter 9 revisits the distinction between investing and speculation, and the results that can be expected by intelligent investors. Graham suggests that intelligent investors should focus on intrinsic value and a margin of safety, rather than market trends and speculation. The chapter emphasizes the importance of discipline and patience in investing, as well as the need for a long-term perspective. Graham advises investors to remain focused on quality and diversification, and to avoid the pitfalls of market fads and speculation. In conclusion, The Intelligent Investor, by Benjamin Graham, provides valuable insights and guidance for investors seeking to construct a successful investment portfolio. Its principles of value investing, intrinsic value, diversification, and a margin of safety have stood the test of time and remain relevant today. By following the key takeaways from each chapter of the book, investors can become more informed and intelligent, and increase their chances of success in the market. The book emphasizes the importance of fundamental analysis and a long-term perspective, and encourages investors to maintain a disciplined and patient approach. Thank you for watching this video on the key takeaways from The Intelligent Investor by Benjamin Graham. We hope that you found it informative and helpful in your investment journey.